Real estate investing, probably one of the hottest wealth building strategies in the media today. Everywhere on the internet, TV, everywhere, real estate investing is made to be the sexiest thing out there. It's made to look easy. It's made to look like any and everybody's doing it and should be doing it. Reality of it is, it's a phenomenal wealth building strategy, especially when you're referring to buying whole real estate. That's a fact. A lot of hype for a lot of good reasons. Major corporations and institutions down to mom and pops, everybody's diving 10 toes trying to figure out how can I get into real estate and start to expand, my portfolio and build more wealth. So let's jump, let's cut to the chase. What exactly is holding most of us that have not gotten started or have not been able to successfully scale back from doing so? What's the biggest roadblock or one of the biggest roadblocks in the way? For many of us, it's financing, finding a consistent, reliable form of financing to take down rental properties. And that's a very valid roadblock and concern. Other than buying a property right in the beginning, because most real estate investors will tell you, you make your money when you buy. Financing that deal and structuring that financing effectively can make a huge difference on if that investment property is profitable for you in the short, intermediate, and long term. So what we're going to cover today is about a dozen different financing strategies that will help open your mind up to the different avenues that you can take when you're starting to figure out how you're going to start financing this investment strategy and getting started. Having your financing in order, knowing what strategies are going to fit for what you're, the type of investing you're planning to do, and how to qualify for it, is going to be very important. It's going to remove a lot of barriers to entry. So that's what we're going to cover today. I'm going to cover these different strategies. We're going to cover a little bit about what they are. Some of them will be familiar, some of them may not be. But we're going to cover some of the pros and cons and who it might fit for. So before we get started, I want you to take a minute, like the video, subscribe. If you continue to support the channel can continue to support you. We're going to continue to put out high quality content that's going to help you build out your personal blueprint for prosperity. So let's get started. So let's cover 7 of the major benefits to investing in rental real estate. And there's a lot more benefits to investing in rental real estate, but 7 of the hottest ones are going to be the rental income, capital growth, diversifying your assets, tax benefits, and within those tax benefits, being able to write off or, interest, the depreciation of the property, repairs, writing off a home office if you're a landlord, even writing off the insurance costs on the property, all can come with some great tax benefits. This is also a phenomenal retirement vehicle. Being able to, buy your first property or buy a series of properties, maintain those properties, keep good tenants in them, and know that the property is going to get mortgage paid down. It's going to continue to get increases in rent in most cases and also appreciate in value. This is going to be an amazing pot of gold at the end of the rainbow when you get to your retirement stage. A reliable exit strategy. This is also an underrated benefit to investing in real estate. It's not talked about a lot, but the reality of it is, in most cases, if you hold on to a property long enough, there's, economic cycles involved. Obviously, there's good and bad times to try to sell, but the reality of it is, in most cases, when you hold a property long enough, you can be certain that you're going to, at minimum, get your money back or likely make a profit. This makes this one of the most stable and reliable exit strategies of any other investment vehicle out there. So, we're excited. The hype is there. We know that this is a great strategy. What are the different financing options that can get us in the door and actually help us scale our real estate portfolios for the long haul? Let's start with number 1. And that's going to be private money investors, private money lenders. Private money lenders are going to typically be private individuals or companies that have excess capital that either cannot, will not, or just don't have the interest in personally buying properties themselves, but want a piece of real estate profits. They know it's a great investment vehicle and that there's a lot of different room for profit for, multiple different, partners that may be involved in the deal. So these are going to be anybody from your neighbor, your family member who maybe have some excess capital or retirement funds, or, different networking opportunities. You may meet other professionals. Anybody who has the capital and is willing to go in on a deal with you is a private money investor or a private money lender, period. What are the benefits of private money investors, private money lenders? Well, they're going to be probably the most flexible form of financing available. This individual or this company or group is going to basically have excess capital, and you're going to come present a deal to them. And you guys are going to literally hash out the structure of that financing from beginning to end. And this is a beautiful benefit because this is going to allow you the ability to contour and configure this financing around your needs as an investor. This investor is largely going to be looking to just get a safe return on their capital, and you guys can negotiate how they get their return on capital. You're going to want to find out what type of return they're looking for, what type of exposure level are they looking for, and when are they looking to get their money back. There's three of the main things when you're dealing with a private money investor or lender that you need to know. Y'all excuse me. The next thing about private money lenders and investors that may be a little bit of a drawback is, first off, going to depend on your sphere of influence or your network. Do you know people who have excess capital or have capital that they're willing to invest? If not, are you willing to meet people? Are you willing to go out and meet individuals who may have the capital that you need to get started or to expand your existing portfolio? This can be a hurdle in itself. Not everybody's comfortable with that. Not everybody's comfortable, asking, presenting this opportunity to people and, getting them to see the value and to, trust them with their hard-earned money. And this is a fair concern. You need to ask yourself, is this a good fit for me? Am I going to be comfortable going to people I know or people who I don't know and bringing this potential, opportunity to them and asking them to be my partner and to trust me with their capital? The next difference is, in most cases, private investors or private lenders are going to look for a pretty reasonable return on their money. So you're going to definitely be looking at an interest rate and potential terms that are going to be a bit more expensive than if you were financing through a conventional or traditional bank, which isn't the end of the world because, again, it's all about trade-offs. The flexibility that comes with a private money lender is, almost unmatched. So if you have to pay extra points or a higher interest rate to help them get a more valuable return, as long as it's in the deal, as long as the property is going to spin off the proper return, then it's probably going to be worth it. So our next financing tool or strategy is going to be hard money lenders. Hard money lenders are going to typically be licensed, structured companies and institutions. Hard money lenders are more than likely not going to be everyday individuals walking down the street or that you may go in the grocery store and run into, or, in your local club or group. Hard money lenders are going to typically be structured companies. What are the benefits of hard money lenders? They are great for short-term capital. When you are looking to take down deals fast and you're looking to take down deals and you have a huge gap in capital. They're great when you're doing value-add real estate investing. So basically you're buying properties that need some kind of rehab or a renovation or a sprucing up. And you know for sure that there's going to be a significant bump in the value of that property when you're done renovating it. Hard money lenders are great for that short-term, filler to take down the property, get you the money you need for the renovation. And you are typically looking between 6, 12, and 18 months to cash them out with a more stable, longer term, financing option. What are the drawbacks to hard money lenders? Well, they're a lot more strict than your private money lenders are going to be. And oftentimes these two get mixed up. Private and hard money kind of gets thrown in this pot like it's all the same, and it's really not. Hard money lenders are a lot more structured. They're going to be very specific on what type of properties they're willing to invest on, what type of returns they're looking for, fees and points that you're going to have to pay, underwriting guidelines, and their exit strategy, the time that they're going to want their money back. These are going to be things that you're going to walk in and have to bend and mold to, versus with the private money investor or lender. They're going to be willing to negotiate back and forth to come up with something that works for everybody. So there's a lot less flexibility, but there's speed, and they're going to be a lot more flexible on the type of deals that they're willing to do. So, your private money, investor or lender is not, may not be, or even a bank, for instance, may not be as comfortable with a property that needs work, for instance, or whatever the case may be. Hard money lenders are going to be very flexible when it comes to like whatever parameters on properties they're willing to invest in. They're going to be willing to do that at a pretty broad range. They're also very good for leaning their underwriting towards the property. How quality is the property, the deal that you're bringing to them, and then lessening the demand on you as a borrower. If the property is strong enough, if it, has great enough, ARV, after repair value, if it has good rental potential, or whatever the case may be, if they know that property is handled properly, that it can turn over a certain amount, then to them, that's a good deal. And they're willing to lean, their underwriting, 50, 60, 70% of their underwriting can be around just the property. So you have more homework on bringing them a good deal, which means that you might not have the best credit, might not have much capital, you might not have any significant collateral or any other form of security other than the quality of that deal. That gives room for individuals, who may have challenged credit, low capital, but you have real estate investing skills, or you're really good at finding quality properties. This is going to be a hard money lender option. What's next? Self-directed IRAs. Self-directed IRAs are a phenomenal tool for those who are in the space to benefit from it. What do I mean by that? Really quickly, IRAs are going to be basically deposit products that bridge the gap between other deposit products like a checking or savings, and investment products, typically in the stock market exclusively. So if you either have capital, personal capital that you're looking to invest, or rollover funds that you're looking to invest from, like your personal capital or a rollover from a previous job or employer, going into your IRA, and then from the IRA it goes into a brokerage or some other investment, typically stock market related investment vehicle. Self-directed IRAs, where you take that same bank IRA product, you find an alternative, investing company, a self-directing IRA company. They exist. Basically, that functions around the legislations and laws that allow that IRA to be put into a certain structure, like an LLC, and allows you to invest in alternative assets within that IRA. So what does that basically mean? If we're focused on investment properties, you're basically able to take, if you have an existing IRA that has a significant amount of capital in it, you don't know how to deploy it, and you're open to rental real estate investing, you would be taking this capital, setting up your self-directed IRA. It doesn't take long. It's pretty easy to set up. There's some very strict rules, but once you're in place and everything's set up, you're able to buy properties within that IRA. The drawback or caveat to that situation is most of these investments, these alternative investments, are only accessible to you at retirement age, which is currently 59 and a half. So if you are somebody who maybe is really young and you're looking to take advantage of some of these investment strategies earlier in life, or whatever the circumstances may be, then this may not be the most attractive financing option for you, but it is important to know that it's available and out there. The next investment strategy, or financing strategy rather, that you should be looking into or weighing out is using a loan from your 401k. Your 401k is obviously a retirement product, that is an added benefit from most private companies and employers. If you have a 401k and it has, a reasonable amount of capital in it, in most cases, you can take a certain percentage of that IRA, like 50% or $50,000, one of the two, whichever is the lowest, and take a loan out against it. Fixed term, fixed interest rate, low, cheap interest rate, usually single digits, and a term usually can go out as far as 5 years. You're gonna have to contact your HR department and dig into the details of this because it could be a little different per company, but on average, these are the general terms. This can be a phenomenal short-term and financing option, yet again, for taking down investment properties or at least getting your first one. Because again, you're looking to maybe get, that 25, 30, 40, 50,000 you need for a down payment, or, to take down a property altogether, depending on, what market you're in, if properties are that cheap. And then you're going to usually try to, put some work into it, rehab it, up the value on it. And then again, find longer term financing and cash it out and put that money back into your 401k. Or you may end up putting the money into by taking down a property on, using that loan from that 401k, and you're using the rental income to pay off that loan. So it still works out, but this is another option that's available for you. All right, y'all, we rolling. So here are a couple more very valuable options. And one of my personal favorites, if you can structure yourself properly for, is going to be relationship banking. Relationship banking, turn into your local, again, smaller region, maybe small regional banks, credit unions, and going to them. A lot of them offer real estate investment financing options. What are the drawbacks? We'll start with the negatives. The negatives with this is going to be they're very leery, if not flat out not interested in properties that need a lot of work and can't pass inspection. They're usually going to want to finance properties that are already stable, which is why they're typically the back-end long-term financing option for most real estate investors. Once the property's been taken down, rehabbed, and a tenant has been placed in a property already, then you turn to banks in most cases. But there are exceptions. There are a lot of small local banks that will work with you if you have your ducks in a row on the type of properties that you may be investing in. So they may support getting a property that needs work. The benefits to this is going to be, in some cases, unparalleled, because you're going to get usually amazing interest rates, very little to low fees and points, and very stable fixed terms. This is not easy to find in, the financing space for rental properties. A lot of the options I've already named, not all, but a lot of them, they can have balloons or they get more expensive over time. You get a longer term, it's fixed rate, it's stable. This is going to be one of your most attractive long-term financing options. The next option is going to be owner financing. Whoever owns that existing property that you're looking to take down, you can often structure terms with that owner to finance the property to you. This works best typically if the property's paid off already. It can work if there's a mortgage still on the property. It gets into a little bit more deeper of a financing strategy. But owner financing is a terrific strategy for taking down real estate investment properties, especially if you're looking for more flexibility and not looking to have to put a lot of cash up and possibly even not have to get your credit involved. Owner financing is an awesome option. Tap into your home's equity. Another valuable financing option for taking down real estate, rental real estate, is going to be home equity loans and lines of credit. If you are already a homeowner or you own rental real estate property already, then tapping into the existing equity can be another stable, short or long-term option for you for financing. This is going to be beneficial from interest rate, costs, and terms in most cases. Drawbacks is going to be the underwriting portion for the most part, and sometimes, where that capital can be deployed. But typically when it's, real estate investing, that's usually going to be okay. Underwriting is going to be the biggest hurdle because you're usually going to have to go through, a traditional bank that's going to go through standard underwriting, and they're going to be scrutinizing you as the borrower. They're not really going to be focused on, collateralizing the property that you're taking down and stuff like that. You're going to need pretty strong credit, usually need some kind of capital, or the equity is going to have to be sizable in the property. You're going to have your documentation, be prepared to show W-2s and pay stubs. You're going to have to go through an extensive underwriting process. But if you can pass that, then this is a phenomenal financing option for rental real estate. Cash out refinances. This is going to piggyback on the equity portion of your, financing toolkit, if you will. Cash out refinances are going to be, the other side of tapping into your home's equity. Home equity line of credit is going to be more of a recycling of the equity in your property, like taking it out as a loan, paying it back, and then reusing it if you decide to. Cash out refinancing is going to reset the terms of your home loan altogether. It's going to restart the clock, and you're going to take out a lump sum of cash at that one time at the closing table when you cash out on your equity, when you're refinancing. You're also going to reset your interest rate to the current interest rates at the time of your refinancing. So if you're in a really good interest rate already and you're, in the original loan, and then you're looking to refinance to get the cash out, but the interest rates are significantly higher in the current economy at that time, it may not be the most attractive option, but it is another option on the table. So really quickly, we're going to breeze through these last few options, and I want to, kind of put these on your mind. Peer-to-peer lending. So this is going to kind of fall into your private investor, private lending space. But this is basically going to be, another popular way that investors can gather their capital together. So, this is a way for investors to connect with borrowers who need financing for various purposes, and investors like themselves that are looking for alternative investments. So basically, in plain English, if you're looking for different financing options, and there's individuals out there who are looking to pool this money together, the difference with peer-to-peer versus necessarily private investors or private lenders is going to be that peer-to-peer can be money that you pool, that is pooled by investors who may not be looking to lock in on the property in particular that you're going to take down. They are just looking to lend you money and get back a return, like a fixed interest rate on that money that they lent you. And they're not going to be as tied to what you're using the capital for, versus private money investors or lenders who are literally going to be tied into your real estate deal. Life insurance policies. So some of you may have already kind of ran across this concept, but properly structured whole life insurance policies can be a phenomenal wealth building tool, a great place to store capital, and it's a phenomenal place to borrow money once you have it in place. Another option is going to be personal or business credit cards or loans. So this is going to be great for short-term capital, but in most cases, this is going to be too expensive in the long run to keep. So for the credit card side, you're going to be looking at 0% interest rate offers, finding companies that help you get the capital off of these cards, or will help you facilitate taking the money off of the card to close on the property, and getting the property stabilized and cashing it out with some kind of long-term financing before that credit card starts to accrue interest. Personal loans are fixed rates typically, but higher interest rate loans. So you're also going to be looking to take that capital, take the property down pretty quickly, and hurry up and cash out that loan before that interest starts to eat deeply into your profits. But it is an option. Margin loans. This is going to be one of those lesser known options that exist. But if you are currently have a stock portfolio, or you're a stock market investor, you have a sizable portfolio, there are banks and institutions and private companies that will actually lend you money against your portfolio as collateral for very low fixed rates and pretty reasonable terms, either loans or lines of credit. And you can use this to deploy into real estate deals. So this is something for those of you out there who have very significant, stock portfolio size, size investments, and you're looking to like double dip that money. It exists. It's definitely out there. We're going to cover each one of these financing options in more depth in individual videos, but I wanted to put together a comprehensive video of the various options that are out there. So we just covered about 12 different options, that you can deploy, 10 to 12 different options you can deploy to start taking down rental real estate. This is going to be key for you in developing your success in taking down these properties and getting your real estate career launched and making sure that it stays sustainable. I hope you guys found value out of this video. I enjoyed spending my time with you guys and bringing this valuable information to you. This is JP, your financial architect, helping you to build your blueprint for prosperity. I want you to stay focused, stay in motion. I'll see y'all soon.